Good afternoon, Tony and Jordan, and welcome viewers. We're here for the market update for the month of June in 2025, and we've had another very positive month after there was quite a tumultuous April with market movements, and then I think in our last update we just come off a pretty solid month, and now we've gone back to back with improving sentiment in global markets and in Australia here. We've obviously had an election and another rate cut from the RBA. So things have been relatively positive overall. And really, we're happy with the one change we made to the portfolios last month. We removed in our capital an Australian equity managed fund from our SMAs, and then brought in the Beta Shares Australian Quality ETF. And that's got off to a really good start in the last month. So overall, it's been nice that things have settled down a little bit for the positive. And that one change we made, Tony, was just basically bringing in an ETF that was a little bit less concentrated, a little bit more closely linked to the market with some more financial spread. And so that's been a really positive change so far.
It's been an exceptional change. I mean, it's actually outperformed the ASX 200 for the month by over 2%, and was actually, out of all the underlying investments in the portfolio for the last month, was the star performer at just over 7.5% for the month. I mean, on an 80-20 portfolio, you're looking at sort of a net 8% return over the space of a year. So for them to, it was a very positive swap out to be able to get them in at that time. But also, to another change that we made back in December was another stellar performer, where we went and we brought Aurora's in, which is another concentrated fund, purely US equities, but had no exposure to the Magnificent Seven. And that also had a stellar performance as well. So overall, those recent changes, including gold as well, have actually all been extremely positive for the portfolio.
Yeah, and there were certain sectors within the ASX, even the technology sector in the ASX, moved up a lot in May, and so some of the managed funds and of course the ETFs as well captured a little bit of that across the month. Um,
Ausbill's Australian equities is a classic example of that for the
yeah,
12, it's both in the ESG and non-ESG portfolios, and that's actually been our star performer, especially from an Australian equities component, where its performance over the 12 months, it's just been shy of, it's probably been about 70% higher than the ASX 200.
yeah,
So it has performed well. I mean, in all fairness, we did keep it through the COVID. We did keep exposure there. Did get hammered quite a bit during
it did.
COVID, but
Yeah.
yeah, but its performance for the last 3 years has been exceptionally consistent, and the last 12 months, as I said, an absolute star performer as well from an Australian equities component.
Yeah, absolutely. And they're a big manager, and they have stuck true to their thesis and within that mandate of that fund, that they did have periods, particularly I think when the Russia-Ukraine conflict first started, and there were certain sectors, particularly materials, they were a bit underweight, and we did question them at that time because they were underperforming. But yeah, I mean,
Having an ESG focus, though, you could kind of see the reason why. I mean,
absolutely.
you could see why people were flooding into the sort of materials sector, based on the fact that Australia was, especially with our large neighbour called China, needing to buy some of our resources and materials again. It was a case of that. It would certainly going to bolster that sector of the market, but as you said, they true to their thesis of having an ESG focus, and have shone through tremendously well.
And that's kind of been the opposite in the last 18 months, with the materials of the ASX 20 in particular lagging, and the financial services really carrying the index.
Yeah, that's
And
correct.
yeah, I mean, we can barely help but keep talking about Combank and how high it's trading, but it's not slowing down either, So it's carried the index for a fair way.
Well, we
And
heard today, and obviously they're
yeah,
not clients of ours, but there's a family office out of the US that just placed $1 billion trade. in Comback shares. I mean, wouldn't you love to have a client like that? Sorry, got to all my other beloved clients, but $1 billion trade on one share from a family office.
Yeah.
So that's
They're not. They certainly don't think that PE ratio of 32 is reverting back to the mean of 16. They're pretty happy buying in at an all-time high. So yeah, it's
the question does have to come down to when you actually have a look at the other banks' PEs, usually sitting sort of around about that 15 mark. And I'm talking about the major banks, the sort of other major three, because even though Commonwealth Bank is called a bank, it's a diversified. It's more like a merchant bank in a way. It's very diversified in what it does. But in saying that, it's you then have to question that a lot of, I mean, from a safety perspective, the quality of our banks is second to none on a global scale. You know, it is not fully, but it is basically backed by the government and also our regulations, very, very strict regulations. And as a result of that, you know, if this family office and other international managers love Comback and pumping it up, and it is probably the best run bank in the country
yeah,
as well. So it does look after my little ATM card and a few other things. I think our company accounts are through there, but it's that's not going to bolster their share price. But but I think though when you have a look at the other banks, if the same thesis applies, there has to be some pretty decent longer term buying at the current PE ratios of the other say three banks as well.
yeah, yeah, absolutely. And yeah, so things have developed nicely in Australia. And as for overseas, I mean, there's been a lot of headlines recently, as there always are. But in particular, over the last 2 months, it seems like we had Donald Trump and Elon Musk being best buddies, and quite a bromance going on, which is now ended. You wouldn't know that so much has been going on just from looking at the investment graphs, because it's we've had a pretty sharp rebound, but that's fallen apart. We've had this the easing of the tariff talks, the big bill. So there actually has been quite a lot going on, but yeah, not reflected across all sectors of the market.
I would like to hear the conversations between the bromance of Trump and Musk because we do know that whatever the story is with newspapers, they do like to sensationalize no matter what side of politics you are on to get the most eyeballs and the most listeners. So it would be really interesting to see what it is behind the scenes. But in saying that, I did make a comment to one of our colleagues yesterday who was talking about Tesla. And I said, well, the thing is that if people either who vote right or left in the US are going out there and burning their Teslas, you do realize that, if you were to own a Tesla, Vaughan, I know you're a push bike man, but if you were to own a Tesla, if, somebody burns your Tesla and it's written off, you can go to the insurer. What do? They just buy you another Tesla. All it's doing is pumping up their Elon's share price and wealth. I don't know. I don't know
No skin
if
off
it's
his
helping the
nose.
cause in a way.
Yeah,
But
that's
anyway,
exactly
such is
right.
life. Yeah.
Yeah, so I mean, despite all this tumult in the headlines, there's actually, I mean, this May was the best performing May in the US market since 1990, which
In fact,
was, flies in the face of the old saying, sell in May and go away. It's really quite the opposite. If you sold in May this year, you're negative 10%, really.
yeah, I think it does go to prove though that staying the course of the journey is actually what's vitally important. And even though the last 5 years have been, in my 33 years in the industry, the most tumultuous and volatile 5 year period I've ever seen, I think there's been 62 major drawdowns in excess of 3% in the last 5 years, compared to the average of around about 21. So, but if you have a look at the average returns that we've got for our clients over the last 5 years, they've all been double digits and pretty good over most rolling 12-month periods.
Yeah,
You know, even
absolutely.
even even coming out of COVID, the 12 months out of COVID, we still got close to double digit. If you include the dip and then the ride back. So you know, sometimes as volatility can actually provide some unbelievable opportunities, some of those
Yeah.
buying opportunities. And
This time's been no different. We're basically back where we were, well, actually above where we were before this big drawdown started. So
yeah,
it was a great opportunity. That's right. So we actually, upon meeting with Evergreen for the investment committee meeting this morning, we haven't made any changes to the portfolio at this point in time. So we're really comfortable with We made quite a few changes in April and then one major one in May. So for the time being, the SMA holdings are going to stay the same. We are, however, looking at just making some small alterations to the defensive side of the portfolio. So the equities being the growth side that we are quite comfortable with. But we are just looking at including some Australian credit into the fund, which is something that we're just doing a bit of work on now, and we might see some changes to that shortly. But just ensuring that we're getting the best value and side of the portfolio, which for some of our clients are 30 to 40% of their holdings as well. So still quite a significant amount of money is invested in bonds, credit funds, and even some cash funds. But yeah, Australian credit is something that we think is quite attractive at the moment.
Yeah, I agree with that, and especially over international or international bonds, at least with the longer duration. But in saying that, I mean, there are some other funds, international funds, that we are certainly keeping a very close eye on, and whether we add them, they're sort of your mid to small cap. And when we talk mid to small cap in the US, we're still talking, potentially top 10, top 20 holdings here in the Australian market in respect to size and market cap. But in saying that, we are looking at a few of those funds, depending on where the markets lie, of just giving a bit of diversification into that mid-cap range from a US perspective and international perspective as well. So we've done pretty well with Coopers when we brought, since bringing them into the portfolio from an international perspective. Bit rough to start with and came back really hard and have done really well. So yeah, so we are keeping our eye on that. Whether we add them in the future, we'll see. We'll just see the stability of what happens after the next tariff announcements. But it looks like things seem to be going as per what they've planned, and they should be able to raise a bit more tax moving forward based on the tariffs and what they've come out with. So we'll see what happens.
Absolutely, yeah. So look, we're working on a few things in the background, but at the moment it's been another good month, so we're pretty comfortable with where the holdings sit. And yeah, of course, as always, we're only one geopolitical conflict away from having a speed bump.
Another opportunity.
Well, exactly right. Yeah. So you never know. Boxing Day doesn't just come in December in financial markets. So let's just see. But that's about it for this month of June.
Thanks, Vaughan. Thanks, guys.
Thanks, guys.
Yes.